How we doing today, folks? Doing well. So yeah, Friday today, which we're back to our normal schedule. So for the next few weeks, we're going to be having Excel Friday, and then we'll be doing some AI activities. So just a little bit of context, we've got this activity and then a few more after this. Next week, I haven't really settled on an activity. I'm hoping to do some open-ended projects. At the very least, we're going to talk about how to use AI as a writing tool, which if you've ever taken a class that has writing intensive, your instructors will probably say you are not allowed to use AI to write reports. Personally, I think it's a great idea to use it because it is one of those things that will be used in the future. I'm not saying you have to write your report for this class with AI tools, but I don't discourage you not to do it. I will say if you use AI for writing reports, you do need to be very conscientious about making sure that you review the detail. We talked about the hallucinations and what it comes up with. And so if you're going to be using that for your deliverables, make sure that you thoroughly review it. And when I say thoroughly, I mean thoroughly. I mean every single point, every single line, you should make sure you review it. If you want to put citations in there, make sure the citations are correct. But at no point I'm going to tell you don't use it. I'm an advocate for working smarter, not harder. And I think this is one of those ways that we can actually improve engagement. So that's going to be one of the things. I'm also hoping to show how to develop a HTML script in AI. This is something I just recently learned and I haven't quite mastered it yet, but I think it might be a little bit of fun to see if we can do that. But yeah, that's what I have planned for next week. And then after next week, that's when your first deliverables due. So I know it's been a while, but we are at the end of week 9, which means that after this week, we've only got 6 weeks left. So we're almost 2/3 of the way done. It's going to go by very quickly, so make sure that you're up to date on that and you're prepared for your AI projects. I've heard some really, really interesting and cool ideas, so I'm looking forward to seeing what you all come up with. All right, to start out, let's go ahead and do some Excel work. Now, these Excel assignments are going to be a little bit different than what we're normally doing. If you want to follow along in the book, these are just the labs that are in the book, the demonstration labs that are in the textbook. I'm going to walk through them at a pretty fast and high level, but you can walk through the instructions. It's not particularly difficult, but they do represent some of the concepts we talked about. There's also a few things that threw me for a surprise, or threw me for a loop, to surprise me, but we'll talk about that here in just a second. So our first analysis, remember we've talked about 4 types of analyses: descriptive, diagnostic, predictive, and prescriptive. We're doing descriptive and diagnostic today. We're going to do prescriptive and predictive and prescriptive next week. And as you can probably guess, the difficulty of these become a little bit more challenging and the tools that we use become a little more complicated as we get higher levels. I will argue that probably you can't really do fully effective prescriptive and predictive analysis in Excel. They're reasonable. They're not bad. They can be useful, but you'd want to use more detailed analytic tools for those particular assignments. So let's go ahead and talk about how we're going to do a basic data analytics, descriptive data analytics assignment. We're going to do accounts receivable aging. So have you talked about accounts receivable aging in your classes? I know some of you have taken 302 and probably are familiar with this, but is everybody familiar with the general concept? The idea behind it is that if an accounts receivable is past its due date, which normally it's going to be 30 days, it's when they're usually due. It's pretty standard for the industry. We want to track that. And our assumption is that the longer that an accounts receivable is past due, the less likely it is to be collected. And so that's how we actually make a representation for our allowance for doubtful accounts, is that we have signed some sort of percentage of representation. Now, we're not going to create an allowance for accounts receivable, but we're going to talk about the basis for that, how we do that. So let's just go ahead and create a few items. And again, you can follow along with this. This is just information that's from the book. But again, I'm going to be going through it pretty quickly. So let's go ahead and look at the data. We've got customers listed here, and I don't like this sheet as much as I like the ones that were in previous editions because it's listed according to number of days past due. So the oldest ones are going to be listed at the top, and the newest ones will be listed at the bottom, which makes this a little bit less relevant, but it's still okay. But we do have 200 receivables, which we probably don't want to sort through one by one by one. So we're going to do some analysis in there. So we got 200 receivables past the due date. Let's go ahead and do some analysis. It's already generally been cleaned, but we're going to add some things to it. So in this column, it's already been formatted for us, so we don't need to change the format. Let's type at the top of the column, days past due. And while we're at it, let's go ahead and change the name of the tab to days past due. Why not? Okay. So we want to calculate the number of days past due. All right. This is the due date. This is today's date that we're calculating. So this is just a mathematical representation. Now, I know I've mentioned this in class before, but date fields are just mathematical operators that have been formatted in a specific way. So we can do a calculation here. So I can just go equals this G1 minus C2. And I have 163 days past due. Now, I'd like to copy this all the way down, but does anybody see a problem with me just doing a flash fill for the way it is? Yeah, we're gonna have to actually set an absolute cell reference for the G1. So let's go ahead and click back in the cell of G1 and hit F4. So we can set our absolute cell references. All right, now we can copy that down. It's just a quick flash fill. And now we have our days past due. Check that, make sure that filled up. Shouldn't be too much of an issue. All right. So this gives us some information, but again, it's not very visually appealing. And as we already know, people are visual learners. They tend to operate with information that's visually adaptive and can show information. So here's something we're going to do. We're going to create a pivot table. Now, I'm not a big fan of pivot tables in general, but this is what the assignment calls for. So let's go ahead and create a pivot table from our items. Now, normally we would just call insert pivot table, but let's do a quick shortcut. Let's make sure your cursor is anywhere in the table. It doesn't matter if it's A1, it doesn't matter if it's B4, wherever it is, hit Control T. That's the shortcut for table. And it's going to automatically identify the data for the entire table. It should be A1 through D201. And be sure you specify your table as headers. That's going to be very important for a couple reasons. First of all, it needs to make sure that we don't try to parse that as part of the data, but also it's going to actually change the format for the data. You'll see what I mean here in just a second. So here's our table data, and we're going to summarize with pivot table. This is part of the table design. We're just going to summarize with the pivot table. I'm curious. Now, something that's very interesting before we summarize the pivot table, something I found, I didn't know this existed. This just kind of threw me for a loop. But when you summarize a pivot table, it automatically formats the data in a filter field. But if you scroll down, the filter field range stays at the top, which I thought was kind of cool. I didn't realize that was something that occur. I've always just freeze panes. So that's kind of interesting that that's the case as you specify table data with the header. We're going to go ahead and summarize the pivot table. Let's just go ahead and we're going to select this table right here. We're going to select a new worksheet and just click OK. Now we've got this set up right now. We got our pivot table, and just like any pivot table, we have to specify what it is that we want here. All right, so we're going to drag a couple of pieces of relevant information. Let's go ahead and pull days past due into our rows and invoice amount into our values. We're not going to put any columns in here. We're just going to leave the row labels here. And let's go ahead and rename the sheet Aging of AR. Now, this gives us a little bit better summary. It kind of shows us the tabular analysis of number of days past due and the number of days outstanding. But does anybody think we can do better? Hopefully everybody thinks we can do better. Otherwise, this is a repetition of already what we've done. So in accounts receivable aging, what are usually the ranges that we operate with? How many days? 30-day increments? Yeah. So if we look, we go all the way down to 163 days, which if we do 130-day increments, we can go up to 180 days. Here's what I want you to do. Somewhere in the data, well, I'd like you to right click, and we're going to go to group. And basically what we're going to do is we're going to change the grouping parameters. We're going to start at 1, and we're going to end at 180. And we're going to group by 30. So 1 to 180, group by 30. Once you've done that, click OK. That looks more like an accounts receivable aging right there. And that provides us with a lot of detail that we can operate with. Because again, remember, when we're creating accounts receivable aging, we can actually format this to make it look pretty if you really want to. I'm going to go ahead and format the cells to be currency symbols. That's completely and totally optional if you want to, but that's just me being all OCD and everything. We can actually calculate our grand totals. And format everything the way you want it. Now, in our accounts receivable aging, what we'd be doing is we'd be assigning collectability percentages to each of these. We're not going to do that, but I just want you to think about the way this would operate in a true situation. is that we'd be assigning accounts receivable aging, and we'd assume that 1 to 30 days is going to be something like 99% collectible, that most of those are going to be collected. 31 to 60 days, 95%, 61 to 90, 90%, so on and so forth, which gives us ranges for how we can actually calculate our allowance for uncollectible accounts. Because if 99% collectible, what percent is uncollectible? 1%. So we would multiply 7986 times 1% to come up with our expectation for our allowance. And we do the same thing for 5% down here, 10%, and so on and so forth. So that's how we would send that up. And of course, when we get down to 150, 180 days, that's half a year past due. We're probably operating like 50% uncollectible, if not more. Okay, so that's how we just identify the ranges. But this does allow us to do some analysis of what it is that's still outstanding and what it is we really need to focus on. So let's go ahead and look at the 150, 180 day range. Now, there's a few things we can do. We can just kind of look here and see that we've got $3,336.51. But what I'm really concerned about collecting these accounts, like my job is to collect anything that's grossly past due. Well, I'd probably want to have the detail of what companies are or what groups this falls into. So let's go ahead and just double click on that 333651. Lo and behold, it opens a new tab for us, which is kind of cool. And we can sort this information according to due date if we want to, which I'm going to do. Sort newest or oldest to newest. Yeah, oldest to newest. Actually, newest to oldest. I'm making up things as I go along. There we go. Not due. All right. Let's go ahead and rename this. Let's just call this 151 to 180. So now we have something resembling a report that we can do for analysis. And this, again, this is a descriptive analysis. What is the question that's asked for a descriptive analysis again? We're saying what happened, okay? And that's all this is telling us. It's a very basic analysis, but we can look and see what's happening within our age ranges, our date ranges, like how many days past due, how many do we have past due? As we can kind of see here, there's some trouble going on at 120 to 150 because we got nearly $12,000 past due at that date, those days, which not an inconsiderable amount given the size of the organization, it appears. So that's something we want to focus on, making sure that we get our collectibles up and running. Now, there's some questions here that we can quickly answer. These are all in the book, and I just want to kind of work with these. So what's the gross amount receivable outstanding for this data set? That's answered by our pivot table right here. What's the gross amount receivables in the 151 to 180? That's actually listed here, which we can check that to make sure that our table comes up correct by just looking at this and seeing the sum up here, 33, 36, 51. All right. What is the number of pays days past due? So we got something like was this taste of tie? So it was 725 taste of tie right here, or tasty tie, not taste of tie. Tasty tie. How many days are past due? 159 days for analysis. And yeah, again, there's not really a whole lot that we can't figure out from this. Looking at the breakdown of total receivables that's listed by here. But again, got a very easy, very adaptive set of tables that we can do for a descriptive analysis that tells us a lot of detail about things that would help us with decision making. This would be something that'd be useful for management. All right, with that, let's go ahead and move on to our diagnostic analysis. This one is far less exciting, unfortunately, but it does deal with something that I'm fascinated with, which is segregation of duties. So what do we say segregation of duties is again? CAR, what do those stand for? I don't have to remember that, Dr. Barnes, because we pass segregation of duties. We will never be past segregation of duties. That'll be forever. Custody, authorization, and recording, okay? So make sure that we people who are responsible for the recording of transactions are not also responsible for the entering or approval of transactions or authorization of transactions. So from a journal entry perspective, we've got some journal entries here. It looks like we got about 50, a little bit over 50 journal entries. You will notice that one column shows the initials for who entered the journal entry, which would be a recording function. And we've got another column that shows who approved the journal entry, which is be an authorization function. What should those probably not have? The same initials. If they have the same initials, we've got a problem because we've got a violation of segregation of duties. So let's go ahead and do a very basic analysis to make sure that we don't have any operations here that are overlapping. So we're going to do the same thing as before. We're going to go ahead and create a pivot table. Let's just do our old traditional pivot table. Insert pivot table. That's going to automatically identify the range for us. A1 through G106. And we'll just go ahead and put this into a new workbook. By the way, again, as always, when you get done with the first workbook, I definitely recommend that you save it so that you can go back and review it for the exam, because we'll be talking about this in the exam. All right, so let's set this up so we can do some analysis. Let's start with columns. Let's go ahead and go columns are going to be approved. And our rows are going to be entered because those are the comparative items that we want. And then for values, you can put either debit or credit. It doesn't matter because one of the things that we'll notice from these tables is that the debits and credits, there's only one debit and one credit for each journal entry, which means that we don't have to worry too much. They're going to be exactly the same amount. So let's just go ahead and select debit. If you want to be a contrarian and select credit, say I go against the tide, Dr. Barnes. That's entirely your decision right there. Okay. Say I don't follow the rules. That's fair. That's fair. I appreciate a rule breaker. Let's go ahead and start out with this on the sum of debit. Let's change the value field settings to count because we just want to count transactions for right now. And zoom in a little bit here so everybody can see this. Let's go ahead and format these numbers real quick. We're just going to change the items. We're just going to change them to numbers. And I want to leave them at 0 decimal places. Which that's not particularly relevant for these numbers right here, but when we do some adjustments here in just a second, it will be. All right. Just looking at this table, does anybody notice a massive problem? So we've got columns. These are, remember, our column labels where these are the people who are approving journal entries. These are the people who are entering journal entries. What should we never have? We should never have the same person entering as approving. There's a problem here because it looks like that we do have an overlap there. We got one journal entry, the same person is entering and approving. What's going on here? Well, looks like somebody entered a journal entry for $500 in cash for a training expense. Is that a little bit sus to you guys? It seems like a little off of controls. Yes. How do you get the numbers so small? Oh, like how did I make it turn to this? Do the count of debit instead of the sum of debit. So we're going to adjust this a little bit for the value field settings. Go to count. All right, so that's certainly a transaction we want to investigate. What are some other things that we want to look at here? We probably want to look and see what the size of our journal entries are. So I set this up as count of debit. Let's go ahead and adjust this. Let's turn this back to sum of debit. All right. That was the reason why I wanted to adjust the numbers there to have commas at thousands, because this is going to be a note. So it looks like a $500 threshold. What does this probably signal to you all if you're looking at this? Now, I want you to think about this. If you're a forensic accountant, you're just like, I suspect everything. I see somebody approving a journal entry that also entered the journal entry. It's for $500. What does that tell you probably? $500, but why $500 specifically? It's just, well, $500 is a lot of money, Dr. Barnes. So that's true. Okay. That is true. I think everybody in this room would be happy with an additional $500. Can we agree? But what specifically about that number? Why isn't it like $327? Why is it not $815? What do you think probably you'd want to look into if you're investigating this further? Because again, what we're trying to ask here is this is a diagnostic analysis. We want to know why something happened. Why did this occur? So we're trying to ask these questions. And unfortunately, we don't have our answers just from the data, but it does lead us to asking additional questions. Remember our context for this with those variance analysis that you did back in managerial accounting? But looking at the numbers themselves, that's not relevant. What's relevant is what is the improminence of those numbers? Why is something unfavorable such a big deal? Why is $500 such a big deal? Seems like it's an awfully straightforward number. You could be saying the authors probably just wrote $500 because it was a nice round number, but it looks like everything else they've got different variants of numbers. $500 just seem like a suspicious number to you? Is it possible that you have an organization that any transactions above $500 are subject to scrutiny or review? So it looks like this person put $500 because they knew that was the exact threshold that would avoid any review. That would be my suspicion here. I need to investigate further, and the detail that's in the book doesn't really tell you that, but that's something to look at. Has anybody ever heard of Benford analysis? Has anyone heard that term? So there was a engineer for I believe it was General Electric. This is back in the 1930s, that was using a logbook and was looking at naturally occurring transactions. And they noticed the naturally occurring transactions at the ones digit with the start with the ones digit occur far more frequently than any other digit. So basically, if you think about a sloping scale downward, like up here and move downward, about 30% of your transactions that are naturally occurring are going to begin with a number 1, then about 22% number 2, about 18% number 3, all the way down to 9. And then the ones that begin with the number 9 are only about 5% of all transactions. So those occur frequently with amounts. So why is that important? Why is that relevant? What would you expect to see if fraud was occurring? What would you expect to see? You'd expect to see a spike at wherever the threshold is. So say the threshold here for a review is $500. You might say, all right, I expect to see a spike at 5 or maybe even at 4, simply because I would expect them to report below the threshold. If you start seeing spikes there, you start becoming suspicious of transactions, because you know in naturally occurring data, it's going to be a natural curve that's going to occur with these large transactions. Again, kind of far beyond that, but again, we're trying to ask questions about what we'd do further in a diagnostic analysis, because this gives us a template for investigation, but doesn't tell us what it is and why we're investigating further. That being said, pretty straightforward analysis that we can manipulate with, and definitely gives us some scrutiny and some detail of what we can operate with. But that does it for our analysis here. These were pretty straightforward. Like I said, next week we'll get a little bit more in detail. We'll operate some tools that are not as familiar. All right. I know what you all been waiting for. You've been waiting for the AI stuff, so I won't hold that back any further. Let's talk about AI. So today we're going to talk about chain of thought prompting. Has anybody heard that term before? So chain of thought prompting is basically an advanced technique for how you set up an AI to do what it is you want to do. Now, I want to kind of throw this out here, is that the idea that we've seen AI tools, especially large language models, they are very eager to please, and they will make up details just to have an answer. Has anybody encountered that yet, where you ask it a question that it can't really answer, but it still gives you an answer, even though the answer is incorrect? To their credit, LLMs are far more advanced than they used to be. They do ask questions now, but if you go back like 2 years ago, if it didn't have an answer, it would give you an answer, it would make one up. I think the famous example, I may have already used this in class, but and if I have, I apologize for repetition, but it's a compelling example. There was a graduate student last year that was asking about under what tax code do I perform depreciation of land? Okay, so what is the problem with that particular question? I know it's an accounting question, but what do we know about depreciation of land? What method do we use for depreciation of land? We don't depreciate land. Land is not depreciable. Okay, so the LLM said, well, depreciation of land is not something that takes place. You can't depreciate land. So what did my student say? Said, but I really want to. And then the LLM said, oh, well, in that case, you can depreciate land and then made up a complete and total fictitious tax code for depreciation of land. The LLMs are very eager to please. Is that a problem? Yes, because if you tell it to do something, it's going to do its best to do it, even if it has to make up information to do it. So that is part of your value proposition as AI users, is not just the fact that you can use AI, but you can scrutinize the work. So how do we understand, how can we tell if AI tools are contextually correct? Well, there's two possibilities, okay? There's two possibilities. One, we can be such experts in our field that we know more about the AI than it does, about a particular topic than it does. Is that likely to be an effective approach for most of the things that we're going to be doing AI research on? Does anybody have the patience to learn more than an AI tool here? I think if we're talking about my cheeseburger consumption activity, I think I maybe know more about AI about that, but that's about it. Okay, I think the AIs have got me beaten there. So that's one possibility, and it's not a likely possibility. The other possibility is that we can prompt the AI to give us better responses. All right, that's what our goal is today. So let's go ahead and use a little bit of educational background. So this is kind of something called, using to what we know from Bloom's taxonomy. Has anybody heard terms of Bloom's taxonomy before? It's basically an educational leveling system that talks about how we learn things in the context of information. So when you're very, very young, you probably start with remembering and understanding. How many people can remember back to when they learned the alphabet? A, B, C, D, E, F, G. Yeah, so you had to learn those. You learn the alphabet, you learn letters of the alphabet, but you didn't really have any context for what those letters meant. That's remembering and understanding. Now, how much of your learning and education operates in remembering and understanding now? So you still do it, okay? But is that what we expect you to do only at Truman State, is to remember and understand things? Probably not. We probably want you to use that information for some contextual purpose. So then we move on to apply, analyze, and evaluate and create. So the more information that you know, the more information you absorb, the more that you're supposed to be able to do with it. Interesting story. Is anybody here planning on taking the CPA exam at some point in the future? So the CPA exam roughly operates according to Bloom's taxonomy. It operates according to remember, understand as the base level, which is just memorization, application, analysis, and evaluation. It does not have creation as one of the types of questions that's asked on the CPA exam. Does anybody want to figure out why or know why? I have a theory behind this. I think it's because a creative accountant is once committing fraud. All right, so that's my thought behind it. But that joke never gets old for me, by the way. So we want AI tools to be able to operate at these levels, but for the most part, they operate at these levels. It's basically just, as we talked about, the token prompts. It's going to provide us context for whatever it believes the next statement is, which is problematic because in order to get to these levels, we need to be able to tell it what to do. So that's where the idea of additional prompting comes in. So normally we operate through something called zero-shot prompting. This is submitting a single exam or a single prompt without examples. So you ask it a question and say, what is the answer to this question? Now, in some situations, this could be effective, particularly if it's a very, very objective question with a fairly simple amount of responses. So an easy example is a calculation that can be very easily found by the LLM. Please remember, most LLM tools do not excel at calculations, but it does excel at finding information that represents those calculations. So if I said, what is 1 + 1, it probably can find that online pretty easily. On the other hand, if it's misrepresented calculations online, it will provide incorrect responses. So I better remember the example that I looked at, how many R's are in strawberry? Well, how many R's do the average person is going to say? If you were to say, how many R's in strawberry? Like, oh, 2, because Berry. You forget about the first R, and that comes off as being kind of the default response. The problem being is that if we talk with the zero-shot prompt, is the AI may not have context for answering the question. So an example of this, about 2 years ago, I had my graduate auditing students input CPA exam questions into the AI tool. And I was curious, how well does the AI tool operate? And the answer was not well at all. It operated at about 20% correctness, accuracy on those. And it was really, really rough. And there was a couple of reasons for that. First of all, it was a very remedial version. We were operating on ChatGPT 3.5. The second reason is that it was able to identify a factually correct statement, but couldn't put that statement in context of the question. All right. So if I asked it, okay, which of the following is most relevant to a control environment of an organization? We're going to learn about control environment, by the way, here in a few chapters. But if I asked it that, and then I would list 4 statements that were all factually correct, but only one of them related to control environment, it would be confused because it would not be able to say, I'm not looking for a statement that relates to my previous question. I'm just looking for a factually correct statement. It would default for the first answer. So we wanted to avoid that. So that's where the idea of prompting comes in. And so we're gonna operate through some additional areas of prompting. So next we have a few shot prompt. And the few shot prompt is basically saying, here's an example of a question with the right answer. Okay, or question with the right answer. Or here's an example of a calculation with the right answer, will probably be a better one. So we give it that particular context and do it a few times and say, all right, you've seen the examples, now do this on your own. Which can be an effective tool because then it actually tells the AI, it tells the tool, here's the approach that you should use. Now that can be really, really effective, but it's not perfect. The next step is going to be something called chain of thought prompting, which is what we're going to be doing today. And we're not going to worry too much about the role-based prompting, but I included it in there just to be complete. So the chain of thought prompting is the idea that it has Gen AI provides an explanation for its responses to verify that it's analysis. So not only does it actually show you what the response is, but it tells you how it came about with that. Now, ask yourself this question. If you were to ask the tool to do something and it gave you an exact procedure of steps that it followed, could you identify any troubleshooting? Could you do any troubleshooting and identify any problems in that process, particularly if it's a fairly simple process? I would hope so. Like say, for example, you wanted it to do depreciation journal entries. How many people have done depreciation journal entries in this room? I would hope everybody raised their hand. I was just asking a question to see how many people were paying attention. So yeah, hopefully everybody raised their hand because the depreciation general interest was something you did back in 220. So yeah, everybody should know how to do that. We can check those analyses. So we give it some examples. Let's walk through step by step, and then we walk it through each of the processes and go step by step to get to our eventual process and understand what was the process the AI tool used to get to that point. So that's going to be what we're doing today. Is we're going to be walking through a chain of thought processing. So why is this relevant? The answer is that chain of thought prompting yields better results. And this is empirically proven. This is a research paper from last year that actually shows in a financial analysis, chain of thought prompting yields better results, not just better than humans, but than other prompting responses. So I know that's relevant to a lot of you. I've heard some conversations about financial analysis and investing. And imagine if you had a tool that could improve your performance above everybody else, instead of just saying, I'm just going to go with an index fund and I'll play it safe. If you could get a competitive advantage, this is a way to actually get a competitive advantage if you learn the routine. So this is one thing that's going to advantage. Now, I'm not encouraging everybody to be aggressive. Says, okay, I'm quitting Truman. I'm going to become a day trader right now. And that's not what I'm advocating for. I'm just trying to say that you can get some analysis advantage in this regard. It's empirically proven. So let's do a fairly simple example. How many people are familiar with the concept of amortization? How many people have heard that term before? I know probably a lot of the accountants in the room here. So amortization is basically looking at interest and principal relevance in a series of payments. It can be used for when you receive interest. It can also be used when you pay interest. So everybody in here has thought about the possibility of owning a car one day. Has anybody actually gone through a loan process for a car? So when you actually go to a loan, so a car itself costs, say, $30,000, and you take out a loan on the car, are you paying exactly $30,000 on the car over the life of the loan? No, you're paying for the principal, which is $30,000, and the additional interest accrued on the loan. So how do you tell when the loan is paid off? And the answer is we can do an amortization analysis to do that. Now, for some of you who've taken the 303 class and done their amortization, you may say, oh, this is pretty straightforward. I remember learning this in Dr. Deere's class. And I say, well, kudos to you, okay? I think that's an important skill to have. But what if you are not familiar with the process of amortization and you want to have a detailed analysis? Well, there's a couple ways you go about it. You can go to the car dealership and say, I don't know how to do an amortization. I'm going to trust that you do it properly for me. And they're going to say, oh, well, sure, we'll do that for you. And then they may rip you off because they're unscrupulous like that. I shouldn't talk bad about dealerships. I've operated the dealership in Kirksville now for several years. They've been very, very forthright with me, but maybe they've only been forthright because they said he's an accounting professor. We can't rip him off on amortizations. All right. Or you can learn how to do this on your own. All right. Learn how to do this on your own with some AI assistance. So we're going to ask some questions. We're going to look at the data. We're going to use the AI tool to analysis, and then we're going to also share the story. We're going to get an initial inclination of how we actually do that in this particular process. All right, so here's what we're going to do. Our activity is going to be creation of a mortgage amortization schedule. Now, I've already put in the prompts for you, and you can pull this down from detail. I will say that when you start putting these into Copilot, I encourage you to paste as plain text because it will try to copy and paste images if you don't. It's not a big deal. It just takes up additional space and hurts the environment if you do too many analyses. But copy and paste plain text. We're just going to do these step by step by step, and we're going to compare our results. So I'm going to give you a few minutes to run through each of these. So how's everybody's inputs going? Pretty good? Other than the people who are getting Python coded for their responses, which, who knows what. So there's a lot of variability that actually occurs in response. I'm going to talk a little bit about that, but let's go ahead and make sure that we are understanding why it is we're doing the prompts this way, okay? So very first thing, we're actually asking an amortization schedule. What input do you need? Now, what is the purpose of this question? Is it to determine what input I have to provide to it? Or is it to validate that it really understands what a mortgage amortization schedule entails? I would argue the latter, okay? I'd argue the latter to make sure that we know what it is. So when I put that prompt in there, what response did we get? I got a pretty good response for that particular item. So it says loan amount, which makes sense. You probably want to know how much the loan is for if you're going to be able to do that. The annual interest rate, the term of the loan, so the number of months in which the loan will be paid, how frequently the payment that takes place, the start date, and any extra payments that take place. Now, I think that extra payments is a little bit extra. That does not something that's additional, but that will change the balance of the loan if you do make extra payments and if you assume those are going to be embedded. So that was actually an addition that I did not expect when I started making that. This was actually similar to a prompt that I received when I revised the slides earlier today. And so I make sure I included that in there. But yeah, you can kind of see that it's pretty robust. It tells us exactly the detail we need because we want to make sure we understand what is the loan amount, how long is the loan for, what is the frequency of the payments, and what is our interest rate. Those are kind of our necessary items in order to be able to make those. Also, if it's a mortgage payments are generally made monthly, kind of the same thing when we talk about auto payments, usually made on a monthly basis. But that's not always the case for every payment that we make. Could be made on a more recent basis or a long-term basis. So then you entered the terms and said, and basically it created the amortization for you and got varying results. It actually created an amortization table automatically for me in that. I didn't prompt it to in that. I was going to set the prompt later, but I wanted to have the inputs. Now, here's another interesting question. Total interest paid if the payments were over 360 months, 180 months, 120 months. Now, this is not relevant to the question because the amortization specified 360 months, 30 years. Why would I ask this question right here? This is another conceptual detail that we need to understand. Now, think about this logically. If you had a loan that was 360 months, would you expect to pay more interest on that loan or less interest in that loan than one that was a shorter term? What do you guys think? More or less? The exact same amount. Okay, I didn't give you that option. The exact same. How many people say more? How many people say less? How many people are thoroughly befuddled right now? Okay, you got to fall in one of those categories, folks. Okay, so if we're talking about a longer term loan, keep in mind that the longer the loan is, the more time that you have to pay interest on that. Therefore, if we're talking about a longer loan, we would expect to pay more interest. That's what I'm trying to get at with this question right here. I just want to say, hey, give me a comparison of the analysis of interest that's going to be paid. If the LLM comes up with a completely and totally different response, how valid are the responses? Are we going to think the rest of the responses are? We're going to say, you don't know anything about amortization. I'm going to chat GPT. So what is the response that it gave right here? Hopefully everybody got 360 months. It played $231,676.38. 180 months is 15 years is 103,000, and 120 months is 66,000. Which, first of all, is that a correct analysis? Yes, that's pretty strong analysis. We could do the calculation on our own to come up with that right there. But secondly, does that really make anybody nervous about buying a house in the near future? So a $200,000 house, you have to pay $231,000 in interest? That seemed like really awkward. By the way, that's I think this mortgage rates are a little bit high right now. I think the Fed lowered the rates. The mortgage rates are becoming a little bit more reasonable. But yeah, I wouldn't recommend, for those of you who are looking at buying a house when you graduate, I wouldn't recommend buying a house. Or if you do, plan on refinancing immediately once interest rates drop. And so, yeah, it's very compelling. I was working with an individual in Trenton. So if you're not familiar with Trenton, it's just west of here, about an hour west of here. And it's a much smaller town, but I was talking to him and he was talking about he wanted to buy a house. And I said, oh, that's interesting. I probably really rough on the rates right now. So I got a pretty good rate. It's like 9%. And I was like that. And he was like saying, what? It says, yeah, don't buy that house. Because yeah, that was going to be one of those ones that he was going to pay an absorbent amount of interest on. And if you wanted to figure out how much interest that'd be, you can use your LLM tool to figure it out. To be fair, it's probably going to be somewhere on the scale of the interest he was going to pay was going to be somewhere in the range of 2 to 3 times what he would have to pay on principal. So if it's $200,000 house, he would be paying $400,000 to $600,000 in interest. That was my estimate right there. So yeah, that's the one thing about interest rates. You got to be very conscientious about them. So graphical comparison. This one's one where I think the LLM tool could do some work. Sometimes I put this prompt in and I get a very good graph. I got this one right here, which admittedly is better than just getting Python code, okay? But this one's one of those ones that I think could be simplified. It could have just compared these side by side, which is something I've gotten on. I think the LLM can do some good graphical analysis, but this one is kind of, I wouldn't present this one as a professional one. It's okay, it's not great. Anyway, so it talks about the information in the chart, and then it presents our analysis. So those of you who've done amortization analysis before, when it actually asks for the output in Excel, does this look similar to what you would get in an Excel analysis for amortization? So what are we looking at here? We're saying, all right, we start out $200,000 balance, which it doesn't take the beginning balance. That's kind of an unfortunate detail. It doesn't have that listed there, but it says our first payment, the payment itself is about $1,199, almost $1,200. The principal on that is $199.01, and the interest is $100 or $1,000. So again, this is one of those things about interest or about housing payments. The early payments you're going to be making, it's mostly interest, and then the principal gets paid off much higher amounts later on. So those interest rates can come back compelling. But yeah, looks like a pretty straightforward amortization analysis. It tells you here's the amount of the payment that we're paying in principal, here's the amount in interest. The principal is, or the remaining balance is reduced by the principal, and every single step we get lower and lower balances. What is our ultimate check to make sure this is correct? This is why we do an amortization table, because we could do these functions in Excel. We've already talked about time value of money functions. We could do all these functions in Excel, but why create an amortization table? It's a check. It's a check to make sure everything's correct. So let's scroll all the way down to the bottom. What should this number be at 360? 0. Okay, that's why we do the amortization analysis. Could it also be useful to find out what you owe at any given point in time? Say you come into a wealthy sum, like say, for example, you invested because you knew how to use chain of thought prompting, you invested wisely and came into a windfall. And so you could pay off your house early and you want to know, how much do I owe my house? I still have, we'll say 90 months left. So this one here, say I probably owe around $86,000, $87,000 roughly rounded up. So this is kind of the advantage of the parameterization tables, which again, not necessarily a tool that you use frequently, but it's one that would be very relevant to your analysis, especially as a home buyer or an auto buyer in the future, which I'm assuming, even if you don't plan on buying a house, most of you will try to probably buy a car, which is very similar analysis. Interesting stuff. And again, this is not just about creating an amortization table and assuming that the tool will do it for us, but also making sure that we can check and make sure the analysis follows what we expect it to see. And I think that the Copilot in this particular context, even though the graphical analysis was a little bit sus, everybody gets a little bit cringy when I use that word, so I get to use the word sus. I'm not that old. When the graphical analysis was a little bit suspect, everything else was pretty solid. Its understanding of the tool was, or understanding of the analysis of what was required was good, and it managed to provide us with some good deliverables that we can utilize for further use. So yeah, that's an example of LLM tool in a particular context that we might encounter in the future. Hopefully you got some additional analysis or benefit out of that. All right, we are back for chapter 3 on Monday. Have a good weekend. Enjoy homecoming.
Thank you, Bonds.
Yes.